So if you're new to options trading, you probably come across that term implied volatility. You're probably thinking, what the heck is that? In this video, I'm going to give you a brief overview of what it is and how we can use it. And as we're getting started here, if you could just hit that subscribe button and that notification bell, that way you can be notified whenever these great videos are put up. So what is implied volatility? Simply, it's a measure of what's expected in terms of volatility of a security's price. And it's derived from the stock price and the strike price of that security. Now, the higher the implied volatility, the greater the expected price movements of that security. It's a measure of how a security's price should change over time. And standard deviation is one way to measure volatility. And we're talking about implied volatility. It is different from historical because it is derived from the option prices, which are influenced by factors such as interest rates, the amount of time until expiration, and of course, the underlying security price. Historical volatility, well, that's based on the past moves of the underlying security. We can see that it's happened. Now, how do we calculate it? Well, the most popular option is the Black-Scholes model, and it's just a mathematical formula. It takes into account several different factors, including the price of the security, the strike price of the option, timed expiration, interest rates, dividends, a whole bunch of different things. Good thing is there's online calculators, but it is helpful to know how to calculate it by hand so you can better understand how it is done. And you can see this example here. Stock price, strike price, timed expiration, volatility, interest rates, dividends, becomes the options pricing model, and then we get the option price. Good thing is we have calculators. So let's walk through a quick example. Let's say you're wanting to buy a call option on XYZ stock with a strike price of $50, expires in 1 month. Well, the current price of that stock is $49. The risk-free interest rate is 2%, no dividends. We plug those numbers into the Black-Scholes formula, we get an implied volatility of 22.76%. So what does that even mean? It means that over the next month, there is a consensus that this stock will have a one standard deviation move of $11.15. In other words, there is a 68% chance that XYZ stock will trade between $37.85 and $60.15 over the next month. And that's just the $49 price of the stock plus or minus one standard deviation. So why is it important? By understanding how all these things are related, you can make a better informed trading decision. For example, whether you're going to buy or sell options, what strike price you want to target, how long to hold your position for. Standard deviation is just a statistical measure. It quantifies the amount of variability or dispersion in a set of data points. That's it. Sounds confusing, right? You should know what that is, though. You can just Google that. In finance, the standard deviation is used to measure the volatility of a security's potential price range over time. And that's all you need to know. The higher it's going to be, the more volatile the price is expected, meaning it has a higher potential to move up or down over time. On the flip side, the lower the standard deviation is, the less volatile the security price is expected to be, meaning it's going to have a lower potential to move up or down. It's a forward-looking measure of a security's expected price range, okay, over the contract period. And so in other words, all we're doing is just measuring how much the security's price could potentially move up or down over time. And again, the relationship between the standard deviation and implied volatility, it's very simple. Keep in mind, the higher the implied volatility, the higher the expected price range, and the flip side. And it's important for option traders because you want to know or have an idea of how volatile the security price might be in the future, and that may help you make better trading decisions. So what are the benefits? Determining whether an option is overpriced or underpriced. So if the implied volatility is higher than historical volatility, then the option is considered to be overpriced. Conversely, if the implied volatility is lower than what the historical volatility was, then the option could be considered to be underpriced. Another benefit is it can help you predict how volatile the underlying security could be in the future. And this could be really helpful in deciding when you're going to buy or sell options. Because if you expect the underlying security becoming more volatile, then you might want to buy options to the upside maybe. If you expect it to be less volatile, you might want to sell. You might use different spreads. There's so many different strategies we can use. Finally, it can help you decide when you're going to buy or sell them. So if you think that the underlying securities can become more volatile, well, then you might be getting a trade on. There's some risks, right? Now, The first one, it's not a perfect measure of future price movement, right? It's going to give you some insight of how the market expects a stock to move, but it's not an exact science. There's going to be times when the market underestimates. There's going to be times when it overestimates how much the stock's going to move. That can lead to losses or could lead to big gains. Number two, implied volatility can change pretty quickly and unexpectedly. And this can happen for a bunch of different reasons. The underlying stock's price could change drastically. You could get an unexpected news event. And when it changes, it can have a big impact on your option prices. So you have to be prepared for the possibility of sudden changes in market conditions. And this applies to trading across the board, not just options. And option prices are affected by other factors than implied volatility, time decay, interest rates. So this means that even if the market's expectations for the movement hasn't really changed, price of the option could still go up or down because of interest rates, because of time decay. You got to keep that in mind. So wrap it up quite simply, it's a measure of the expected volatility of a security's price. It's not guaranteed. In fact, the implied volatility can change throughout the life of the contract. You can compare the implied volatility with historical volatility. So if you find these numbers are vastly different, well, just remember that historical does not predict the future. Neither does implied. But if you're looking for something a little bit safer and reliable investment going forward, we don't talk a whole lot about these. We're talking about dividends. And dividend stocks, what they are, it's basically a company. It pays out part of its profits to shareholders in the form of what we call dividends. And, to be quite honest, these can be an attractive option for investors, traders, looking for regular income and stability in their portfolio, especially as you get into retirement years. So what we did is we put together a list of 101 of the top dividend stocks that we actually look at. You can just download it. It's free. The link is above and it's below in the description. Hope you like it. Hey, any questions or comments, pop them below. And again, make sure you hit like, hit subscribe to our channel. It really helps us out. Thanks for watching.